there. Okay, I'm rolling. I'm recording. Are you?
Yep, I'm rolling.
Okay, here we go. It's ultimate options, and Corey Halliday is the ultimate options teacher. So it would only be fitting that I would be joined by Corey Halliday, the ultimate options teacher, to be in an ultimate options class. And so I'm Andy Tanner. Good to be back with you again. And it's you, me, and Corey. That's it. 3 of us. Let's go. Let's rock and roll. And let's learn ultimate options. We've talked about Vega. We've talked about, we talked about Delta. We talked about Theta. Now we're going to talk about Vega. And we used the analogy last time of, let's say I threw one baseball. I said, okay, throw this up in the air and catch it with one hand, one baseball. Okay, then I throw another one in the mix. Now you got to keep track of 2 baseballs. And I'll tell you, that is an order of complexity that's a lot bigger than just one. The amount of people who can learn to throw up one baseball with one hand and keep track of it with one hand, even alternating 2 hands at a time, is tough. But once you throw that third in, you're really, truly juggling, okay? So the idea is you're keeping track of all 3 baseballs, and let's say one's blue and one's red and one's green, and you're keeping track of blue, red, and green and how they affect your juggling. And that's really how trading options are, there's 3 factors that can affect that premium in the biggest way, the 3 major. There's actually more than 3, but those are the 3 big ones. And the change in price is a big deal, and the time decay is a big deal, and that's time to talk about volatility, right, Corey?
Yep, and Vega is one of those where at certain times in the options life, it's more important than others, right? And so when you think about time decay, it kind of has a similar element. We talked about how late in the options life, it decays at a more rapid pace. Well, Vega, there are some specific times, and we'll talk about earnings and so forth, where Vega comes more into play as an option trader.
Certainly. And so it's really appropriate to have volatility with a disclaimer because stocks get volatile. They get all over the place. And volatility has a lot to do with the risk that are in these options. So let's be clear that this is an educational course. I try to find the most clear language I can possibly summon to say, when a person's in the education phase, and when they're in the learning phase of options, you trade in a paper trade account. You like a pilot, they fly simulator before they fly solo in a real jet. I think it's great to have advisors, but you got to make sure your advisor is a good option trader too. I mean, if I'm going to go up and have Corey teach me how to do this, I want to make sure that he knows about options and that he's traded them before so Corey can teach me this. And so that's why I love having Corey around. He's a great teacher. He has wonderful experience as an option principal, and I just love having him with us. And then also, we're just educators. We're not here to tell you whether or not to trade an option or to go into debt or, what kind of car to buy. Those are your choices. But what we can do is educate you and give you better knowledge about what some of these risks are. And so understand that this is for grown-ups. And with that, were you a maniac driver? Were you kind of one of these punk teenagers that drove like a maniac? You're probably pretty good.
Well, yeah, I was never in any wrecks, but I did damage a couple of cars of my own stupidity,
I had
one specific moment where I actually I hit a bump so hard jumping a car with my friends that we broke the oil line down underneath and whatnot, and so my dad knew something was abnormal happening.
Wrong. If I had a daughter, I'd be nervous. I don't, but if I had a daughter, I'd be nervous when she dates because I know what I was like at 16. Yeah, I'd be nervous. And I do have 2 sons, and I'll tell you, I'm nervous because I know what I was like at 16.
Yep, like father, like son, I'm sure.
Oh my gosh, I remember one time I had a Chevy. God, my parents don't even know this. Good thing they don't trade options so they'd find out. Hey, what happens in ultimate options stays in ultimate options. Okay,
That's
I'm
right.
just telling you right now. So I had a Chevy, and I had a V8, and it was pretty good. And One time I was coming home and I thought, I'm going to see how fast this can go. And I buried the speedometer. I have no idea how fast I was going. I buried it. And now that I'm older, I think, my gosh, a deer comes out or, let alone a person. I thought, oh my gosh, how stupid was I? I mean, I was going so fast. And it wasn't like the suspension and the steering and those things in those days were really, really safe. No airbags.
Yeah.
I don't know if I had a seatbelt in those days. I don't think it was the law to buckle up in those days. So what's the point? Well, the point is insurance man here is going to look at this kid, and the first strike against him is that he's a kid. Not a lot of experience driving, kind of crazy. And the second thing, what has he got right here? He got one of these cell phones, and I'll be darned, look at this son of a gun, sitting there texting in his car. I bet you guys didn't even notice that. See, I noticed these things, Corey. I noticed these things, okay? I might not remember where I parked my car, and I might not notice when I spell something wrong, but I noticed that little cell phone. And I also see this risk coming down the track. Can you appreciate how hard it is to put the word risk on the back of a train? It's not easy. But anyway, this guy's in. And so when this guy's in the insurance, he's going to sell this guy some insurance. What's he thinking in his mind? What's he thinking? Is this what I'm dealing with? Is this what I'm dealing with? Now, my wife, she never breaks any rules. I don't think she's ever broken a rule in her life. Does your wife break rules?
No, not. She's a great driver, very safe. She's a rule follower, no doubt about it.
So this guy's insurance premium, you got this guy here, and then you got, my wife over here. So this is my son, and we'll draw my wife over here. Okay, here's my wife, she has no clothes. We better fix that. Okay, so she's got her yoga pants on, right? She got her yoga shirt on. There we go. Now she's dressed in her black yoga, and she got shoes. The shoes are really expensive. I'm just telling you. Okay. Christian Louis Vuitton. Here we go. And there's Marcy. So while her shoes are expensive, her insurance premium will be lower. And my son's insurance premium will be higher. Why? One of them is a more volatile driver.
Yep. Yeah, you can really put them in categories, right? You put them in categories of it's not even that maybe your son has never done anything wrong in his life either, but because he's in that category of risk, he's going to be priced more expensively, and you can put them in that categories that way. And with stocks, you can do the same thing. Yeah. You can put them in volatility categories. Some stocks, their personality is to text and drive. Now, they're dangerous. And some are just...
If you're a socialist... Okay, let's get political here. Okay, usually I don't talk about religion and politics, but crap, let's talk about all of them. If you're a socialist, you might say, hey, it's not fair to prejudge this guy because of his age and his gender, and it's not fair to prejudge this lady because of her age and her gender. So you're being prejudging, and that's not fair. That's not right. So if you're a socialist, you're saying, look, everyone should be treated the same. We're all equal, right? Rich, poor, right? No one gets treated any better than the other. This kid's never gotten a wreck. She's never gotten a wreck. Why not give him the same premium? And look, you can't prove that. Look, if I'm a smoker, you can't, in health insurance, you can't be prejudiced against me. I enjoy a cigar once in a while. You can't be prejudiced against me. Okay, all you non-smokers. Of course, I've never smoked, but you know what I'm saying? But the fact of the matter is if you look at the actual tables, a male at 16 is probably a bigger risk than a female at whatever my wife's age is. I'm not going to disclose because I want to stay married.
That's a good answer.
I mean, isn't that true?
Yep.
It's
absolutely.
And, but if you're
think about it from the insurance angle. If I'm selling insurance, I want to sell insurance to your wife, and I do not want to sell insurance to your son unless you're going to compensate me for that with
Pay more.
much higher premiums.
So from a consumer standpoint, it's not fair to have different premiums. Okay, but watch this. From a capitalistic standpoint, it's not fair to this guy that he would have to insure this guy at the same price as her. So it just depends on what side you're on. If you're a consumer, you say, hey, I want everyone to be the same. It should be the same. Or maybe if you're a consumer, you say, look, because I'm driving the same. But if you're this guy right here, you're saying, look, I have to charge this guy more, and I'm going to give her a deal because of my risk and how I run my business. So really, This whole analogy is about one thing: risk. The more risk, the more premium. Well, if you have a stock,
we could say the more volatility is another word for risk. Yeah,
sure. So if I had a stock that behaved like this, okay, and I had a call up here way out of the money, and I had a put down here way out of the money, I'd say the risk, and here's expiration out here, I'd say the risk of this thing going above here or below here is very low probability. Low probability. That's probably not even how you spell probability.
Yeah, nailed it.
Okay. But if I had a call up here and I had a put down here, right? Same prices. So let's say this is at, $110, and let's say this is at, $80. Let's say this is $110 and this is $80, and this is right in the middle. Okay? And here's here's expiration out here. Here's the expiration day. And I have a stock that goes like this. Okay? And it's sitting right here. I'd say there's a higher at least. I'd say there's a higher probability that it could be above this area or below this area than this one. Because this one over here has more movement, or more what, Corey?
More volatility. We call that historical volatility.
Historical volatility.
Which means it has a history of being that volatile, and that gets priced into the options. But if you're going to price an option, it just makes sense that you would use its track record for pricing the future. And so as an option trader, what gets priced into the current option premium is the fact of, okay, this stock has this level of volatility historically. Some stocks move 20% a year. Some stocks move 40% a year. Some stocks move 100% a year. They're going to have different option prices because they have different levels of volatility.
Now, here I am grown up, and my ties are longer than that. Here I am grown up in a suit. Okay, I grew up. Here I am in my suit. That is a picture of me. Great big hands. See? And I know you're amazed at my art because that looks exactly like me. Okay, I might be a few pounds heavier than that. My wife's like, Danny, there's 50 pounds on you. I'm not even married. Okay, but anyway, we'll pretend.
Well, compared to the two guys talking about insurance, that's about right. You're about twice their size.
Yeah,
so.
I got to tell you, I probably don't look that good, but it does kind of have a resemblance. Okay, so in other words, as I grow older and I get a good record, there's going to be a change here in this guy's perception. There's going to be a change in the volatility here, right? In the volatility, there's going to be a change in that. And so my question is are my insurance premiums going to be changing? So as my age, this is age, right? And quality of driving record, and this is insurance premium. Maybe that's it. As I prove safety and I get older. So my question is this: how fast is that going to happen? In other words, how does an increase in my age, with how much of an increase in age, how much of a discount should I expect? Or if I get a speeding ticket, right? All of a sudden I get a speeding ticket, my premiums would go back up again. So my question is how does this affect the price? Now watch, why are we spending time on this? Well, we really care about premium and how the premium changes. Okay? If we care about stock price changes, we care about price. Look, we're entrepreneurs, we're investors. We care about changes in price. We care about changes. And so if I want to know how a premium changes, I'm going to say, okay, number one, the stock price can affect, if the stock price changes, that could do. So we said that was what? Delta. That was the first ball we got to keep our eye on. So the first tennis ball we got to juggle here and keep our eye on is the stock price change. Okay. The second, and people can say, gee, this is tough, a lot to keep your eye on. Let me tell you, go into real estate, give that a shot and see what you got to keep your eye on there. Interest rates, mortgage rates, cap rate, freaking population growth, city codes. I mean, you got 1,000 balls in the air. If you think these 3 balls are a big deal, go into real estate. And anyone who's done real estate and tried to do a house, you got buyers, sellers, real estate agents. You got changes in price off just negotiation alone and skill and sale. I mean, it's incredible. So before you throw your hands up in the air and say, oh my gosh, I just want something I can look at one ball and then go buy a mutual fund and pray. But this is going to give us a lot of control. You'll see this. It's going to give us a lot of cool stuff. The time decay was going to affect the change of this, right? The time decay, that was what?
Theta.
Okay, now we're going to say, look, the volatility of the stock is going to have a effect on this, and that's Vega. So delta Greek looks like this, theta Greek looks like this. You know what the Vega Greek looks like? There's
not one, right?
There isn't really a true letter of the Greek alphabet called Vega, I don't believe. Is there? I don't believe there is. So we'll just make it look like that. We'll make our own up. I don't know. What the heck? You got to make your own up sometimes, okay? But that's what it's called. Delta, Delta, Vega, and Theta. And so we already saw that, how do we figure out how the price movement will affect our option? How do we figure out how time movement will affect our option? Well, what I think is hilarious is people will start trading options without knowing these 3 factors, and all of a sudden they'll buy a stock, and the stock will go up, or the stock will go down, and their option price doesn't react the way they thought it would be, like around earnings or something.
Yeah.
And these guys are like, what the heck happened? They're screwing me. The market makers are screwing me. Wall Street's screwing me. Everyone's screwing me because my option didn't work out. Well, you know what? It might have been a drop or an increase in volatility that killed you.
Yeah.
I mean, you could get into an iron condor and the stock price might not even move that much. But if we have a big move in the market that scares everybody, that could increase the volatility, which means it increases the price of your options. So if you want to buy those back, you're going to have to pay more for what you paid. And so you're thinking, wait a minute, the stock price didn't move that much. I haven't had that much time, I move. And yet here I have this huge, or I've had time move in my favor. And yet now I have this huge, I'm behind the 8 ball in my iron condor. Why is that? Well, your volatility probably went up, right, Corey?
Yep, exactly right.
So if I buy insurance, if I sell, now look at this. Let's say you sell insurance to this kid and it's health insurance and he looks healthy. And so you sell him a life insurance policy at 12 years old. So a 12-year-old kid, a life insurance policy for a 12-year-old kid, maybe it's a 20-year policy and he's 12 years old and he's good health. That's probably going to be a really low premium, right? And you say the value of this policy is $100,000 maybe. All of a sudden he gets a terminal disease and they want to buy him out with something called the life settlement, and maybe he's paid, I don't know, maybe $1,000 in premium over the time. I'll tell you what, to buy that back, it's going to be closer to this number than this number. I'll tell you that, because
Yeah.
now that he's sick, the insurance costs a lot more. It's, to buy it back and get out of that promise is going to be a lot more money. So when volatility increases, insurance companies worry. Look, you want to sell flood insurance in freaking New Orleans, great. But all of a sudden, when Hurricane Katrina's in the Gulf and you want to go and say, hey, you know what? I think I changed my mind. I want to get out of this thing. You know that thing I sold you? Could I just buy that insurance back and we could just call it good? Tell you what, you're going to be paying a lot more to get out of that thing than you paid to get into it. You want any comment on that, Corey?
Yeah, I mean, that's a great point where volatility changes will change the option premium in that same component. So, if you sell an insurance policy, you're pricing it on what you expected the volatility to look like. But the volatility of a stock can change. So it might have this type of personality, but all of a sudden, let's say that, BP has an oil spill, their volatility changed.
Oh, baby.
Because now all of a sudden they're leaking oil and they're going to be spending billions of dollars to clean it up. They might not survive and so forth. Well, now all of a sudden the options are really expensive because
you mentioned BP.
The risks on that company changed.
They might
overnight.
not know what BP is. What does BP stand for?
Yeah, I've heard you say this one, broken pipe.
Broken pipe. You thought British Petroleum, but it's broken pipe,
That's
baby.
right.
That's what it is, BP. So their volatility went up. So we want to have a measure of how this might work for us, right? A measure for how this might work for us. So check this out right here. We got a Vega of 23. Well, let's say the volatility is sitting at 15%. So we have a 15% volatility. Now, first of all, this is the toughest one to understand. Just before we get into Vega, if you say a stock has, and we'll call this implied volatility. We'll get into historical and implied. But if a stock had an implied volatility of 15%, tell me what that means. Because I can understand if a stock price goes from 101 to 102, I get that. I know what that means.
Right.
Okay, the price went from 101 to 102. I got that. So price changes. I know what that is. Okay. Time. Okay, it went from today to tomorrow. Okay, that's one day. Okay, I get that. That's easy. But in this one, what the heck is this volatility? I mean, 15%. What does that mean?
Yeah, so implied volatility, we talked about historical is how much that stock has moved, right? That's measurable.
Historic.
Implied volatility is different than historical in that it's implied, it's expected. This is how much the stock is expected to move or what type of volatility it's anticipated to have, and that's what's priced into the options. So you can pull this up on any option you're trading and there will be a little implied volatility number.
Right.
Now, if it has a number like 15%, what that means is basically you could annualize that.
Yep.
And to use a simple example, let's say a stock is trading at $100 per share. If it was anticipated to have implied volatility of 15%, then what the market is saying is over the next year, its range of trading could be up to 115 or down to 85. That's its expected volatility range. And so it's just a way to quantify. You pull up a different volatility number on a different stock and it'll be completely different, right? So this stock has anticipated or implied volatility over it on an annualized basis of 15%.
So if they were to change that and say, nasty things are happening, I think the implied volatility of this might be to $120 or down to 80. That would mean that the volatility changed from this has a 15% volatility and this has a
20%.
20%
exactly
volatility.
Right.
So the change in volatility here would have been a what? A 5% change.
Increase.
Yeah.
Yep, a 5%
There's a fancy
increase
word for this. This is called a volatility cone. Is what that's called, just for fun. This is called a volatility cone. That's saying, look, we don't know whether it's going up or down. That's not our business. We don't know if it's going up or down. We're just saying, at the high range, it's most likely to have a 15% to the upside, 15% downside. for total range share of 30%. This one right here, 20% volatility. And so if the volatility changes from a 15 to a 20, that option's going to get more valuable.
Yeah.
It's going to get more expensive to buy that option because now you're covered, with, whoa, this is a much scarier place to be. This guy's starting driving like a freaking maniac. Now, if you had a $100 stock and all of a sudden they say, no, 105, 95, that's where we think it's going to be in the next year within this. Well, now I have a volatility of, try to guess what Corey's going to say.
Yep.
What's the volatility? Get it before Corey says it. Pause.
Yeah, I'll give you a second.
Okay,
5%.
Wait for it. 5%. Okay. So this is now gone from a 15% volatility to a 5% volatility, right? 5%. So this is a 5%.
And that drop in implied volatility or expected volatility has dropped, implied. What that means is the option premium has dropped. Think of it as the cost of insurance. Cost of insurance means if I'm charging someone insurance to, let's just say a hurricane insurance, okay? We can put probabilities around that. We could say there's a 15% chance or a 20% chance or a 5% chance.
Yeah.
And we're going to charge different amounts based on how likely something is, what the implied volatility is. So that insurance company, if they put the probability at 5%, they're going to charge a lot less than if they put the probability at 15%.
So if we look at this one, in fact, let's draw it this way. I'll try to draw it a little closer to scale. So let's put it this way. Like that. That might be a little better to scale.
Yeah.
So let's say you started with this, option and the stock was $100 and we thought that it could go to, let's say 115 or 85. And we would say this one has 15% volatility. Right? That's what we'd say on this. Okay.
Yep.
And all of a sudden, you buy a call option, you're long the option, or you buy a put, either one. You buy an option, you're long this option, and you wake up in the morning, and maybe the market's had some problems, and whatever, but the volatility's higher. The volatility's higher, and now they're thinking that this could be, 120 to 80. So this has what?
Yeah, 20% implied volatility.
Implied volatility. So you'd wake up in the morning after buying this option, and let's say the option price stayed pretty much the same, and you've only had 1 day of time decay, so it's interesting. But all of a sudden, your option's worth a boatload more. It might be because the volatility went up. Okay, the volatility.
Yeah, exactly. Because think about it. If the stock didn't move, you have no delta change. You only experienced 1 day of theta, time decay. So maybe your theta on this option is, a couple pennies or whatever.
Yeah.
Your option premium, though, jumped. Why did it jump? Because volatility expectations jumped.
Yeah.
In other words,
it's more expensive to buy insurance now, but see, you bought it yesterday, baby. You bought it yesterday. It's almost like buying gold yesterday before the price went up. Look, you bought the insurance when it was cheap and it wasn't volatile. Now that sucker's volatile and it's a liquid market, so you can sell that thing for a lot more money, right, Corey?
Yep, exactly right. The cost of doing anything with that option, and remember that it doesn't really matter if it's a call or a put. The premiums increased because volatility expectations increased, and that volatility could swing the stock up, it could swing the stock down. Either way, right? So both the call and the put would inflate in value. They would increase in value if volatility expectations move up.
Let's say we go 110 and just 90 here. So that would be a what?
10%.
10% volatility. Volatility. I don't know how to spell it. You might wake up, though, in the morning, and let's say there's a nice day in the market. Maybe your stock didn't move much, but the implied volatility dropped. We're feeling good about ourselves. If you really want to get a metric, and we'll learn about this later when we get into individual trades like this, but there's something called the VIX. And what does the VIX stand for, Corey?
Yeah, the volatility index.
And some people call it the what gauge?
The fear gauge, yep.
So if all of a sudden the fear gauge drops after you've bought your option, look, Andy had cancer, he had insurance, all of a sudden, oh, no, it wasn't cancer, it was just, something else. Well, gee, you bought all this insurance, and now that insurance isn't worth as much, is it? And if I wanted to try and get out of it, I'm not going to get as much back for it, right?
And there are all sorts of things that come about in the market that cause that fear gauge to go up and go down. An example, we'll use a couple of fundamental examples, FOMC meetings, Federal Open Market Committee. That's the Federal Reserve in the U.S. Well, 8 times a year, they set interest rate policy. So kind of fear goes up into that.
Yep.
And then they come out and they don't change rates, and the statement's basically the same, and everybody kind of says, "Oh, this was a non-event. It was a dud," and volatility drops because that worry, that concern, which was heightened going in, has now dropped, and everybody kind of breathes a sigh of relief, and option prices drop back down. There's all sorts of little examples of that.
If I had a pharmaceutical company and I've got major money invested in research and development for this drug that's supposed to cure Alzheimer's, and what's going to happen is the closer I get further in trials and FDA approval, if that drug gets approved, and I don't have a lot on my plate, that's going to be a sigh of relief if it works, and it's going to be a sigh of relief actually if it doesn't work, because now I know, right? And so if there's an unknown, are we going to raise interest rates? Are we going to beat earnings? Are we going to get FDA approval? If there's an unknown, volatility and fear tends to be scary when you don't know, right? You're only scared of the things you don't know, right? You're only scared of what you don't know. Once you know it, even if it's bad news, well, now I know, and the fear tends to go away. Okay, now I know what I'm dealing with, but the fear of not knowing in the market is palpable, man. It is, you can feel the people's fear. So anytime you go into an announcement of some kind, anytime you go into announcing them, it wouldn't be surprising to see increased volatility in the market.
Yeah.
And we would think people would buy and sell and position and get out and get in, and that causes movement. Anytime after an announcement, we wouldn't be surprised to see a decrease in volatility.
That's right. And I call that, there are known unknowns, and then there are unknown unknowns.
9/11.
And what I mean by that, a known unknown is you have a date and a time. You just don't know, the market doesn't know what's going to come of it. So a Fed meeting is an example of that. It has a date and a time, and you go into the Fed meeting. The unknown is, well, are they going to raise rates? What are they going to say? Other times there are unknown unknowns. And an unknown unknown is basically something that comes out of nowhere. It's not on the calendar. Nobody was expecting it. It comes out, and then the unknown is, well, how's the market going to behave around that? And those are typically the bigger market hurdles and the bigger changes in volatility and the bigger moves in stocks, because it blindsided the market. So great examples.
Really big. Now, so this is what Vega has to do with. Vega has to say is this is a change lower and this is a change higher. So what Vega has to do is say, all right, if it changes from 15 to 10, how's that going to affect my option price? So watch this. If I have 15% volatility and my option premium is, I don't know, let's just say $7 or whatever, okay? If the volatility rises to, let's say, 16%, that is a 1% jump in volatility. So if I have, so just how delta was the first dollar in price movement, and theta was the first day in time movement, This is the first percentage point in volatility movement. Let me say that again. In delta, it was the first dollar of price movement. In theta, it was the first day of time movement. Okay, this is the first percentage point of volatility movement or change. And so if I have a 23, this is a positive number, positive increase in volatility, my new option premium is going to be how much, Corey?
$7.23. Yep.
$7.23. And so that is a huge thing for you to think about in terms of opportunity. Because, yeah, you know what? I got to juggle these three balls in the air. I got to juggle this ball of volatility. I got to juggle this ball of delta. I got to juggle this ball of price change. I got to juggle this ball of time change. But on the other side of that, this creates opportunity for me, and for you, because if you can begin to get a sense of when volatility could change, see, now all of a sudden, we're not just out there trying to predict price. We can also go out there and say, if volatility increases, I can make money off just increases of fear. Let me say that again. Yeah. You can make money off increases of fear because the stock price didn't change. We didn't have any time go by, and yet we're making money because of an increase of fear. Now, works both ways in the market all the time. If we go down to 14%, well, that's a 1% change to the downside. So I'll bet you can guess before Corey... well, look, I've already got it wrong. I bet you can guess what Corey's going to say right here. That's going to be down to $6.
$6.77.
Yeah. And you just lost 23 cents because people aren't as scared. So, again, I know I beat this dead horse a lot, and since we beat it a lot, let's just beat it some more, can you imagine someone really getting serious about options, really getting serious about them, and not learning the Greeks before they go out and start learning how to go out and trade these things? So that's why I'm starting with these Greeks, is because it's very, very clear to see that volatility, time decay, and price affect the instrument I'm trading. Now think about this as a real estate example. I shouldn't go in and buy real estate unless I know what a vacancy rate is. I shouldn't go into real estate unless I know what a 1031 exchange is. I shouldn't go into real estate unless I know what a cap rate is, a net operating income is, right? I shouldn't go into real estate unless I really know what an LLC is. And so there's just certain things, because all of those things can affect, vacancy rate can affect my income. Repairs. If I'm buying a home, a complex that was built before the year 2000, that's 20 years old. My repairs will be bigger than if I buy a complex that was built 5 years ago. And so there's certain things, this is called financial education. It's the things people don't think about. And so if anything can change the price of my option premium, anything that can change the price of that option premium, doggone it, I want to know about it, or I'm just not being as smart as I can be. Corey, the mic is yours.
Yeah, so when you think about volatility, that's very well said. Think about how you can capitalize on this, because one way we had an increase in the premium, another way we had a decrease in the premium. So essentially, as a trader, what we're trying to do with volatility is when it's too high, when it's priced too high, we want to sell volatility. We want to profit from the premium likely dropping. And when volatility is going to ramp up, we want to buy the volatility. We want to buy the option so that the premium will increase in our favor. And we'll go through that more as we go. But just as a quick example of that, if you could time insurance in everyday life, you would go out and in Florida, when you felt you were doing your studies and you could see that a hurricane was coming, you'd go out and buy insurance.
Yep.
And then when that hurricane was approaching, you might sell it off because that hurricane might veer off and might miss this place.
Yep.
But as it's approaching, you would sell that insurance to someone else and you would make a boatload of money. And so that's kind of how the market works in terms of strategy, where as a strategist in the options market, we're looking to take advantage when volatility is overpriced to sell it, and when it's underpriced to buy it. That's the basic.
And I'm really glad
nutshell.
because that was absolutely a G-rated example of how this works. Now, if you'd like to see an R-rated example, if you're really a rotten person like I am, and you'll go see an R-rated movie, and this is only if you're 17 or older, but if you really want to read an R-rated book or an R-rated movie and learn about this in the R-rated, go see The Big Short. Because The Big Short actually didn't short anything. What these guys did is they saw some collateralized debt obligations that everyone thought were safe and the volatility was low. And they said, we see a hurricane coming. We think these are going to suck. And so what they did is they bought insurance. They paid a premium on an ongoing basis to buy insurance on these things. And when those collateralized debt obligations began to stink and fail, these guys said, look, we have insurance on these. We have these insured. And the premiums for what they bought that insurance went through the roof. And so they could now sell that insurance to, people that needed it at a huge premium. And they got filthy, stinking, vulgar rich. So Corey has a better G-rated version. Buy insurance in Florida before the hurricane comes, sell it the day before it hits, right? And after the hurricane hits, the insurance wouldn't be worth as much anymore because the insurance, the event's gone. If you want the R-rated version, go see The Big Short, and you can have, people in hot tubs with no clothes on teach this to you in The Big Short. So. I didn't let my kids go see I didn't let Marcy go.
That is a fascinating example.
I went and saw The Big Short with Patrick Donahoe because I wasn't allowed. I was going to have my wife exposed to that debauchery. Okay, how we roll.
It is a fascinating example of mispriced risk, though. In essence, when you think about the real estate bubble and then packaging up these mortgages, they were basically taking these very risky mortgages. Interest-only loans, people that weren't making payments. Yeah. And because they linked them all together, they were able to get the credit rating agencies to mark them as, A-rated, great assets because they were just packaged. Well, I'm not sure how you get from point A to point B where you say they're all really bad, but if we package them together, they should be great. I don't understand that.
It's kind of like we were talking about trying to separate my wife's driving from my son's driving.
Yeah.
It really is. They failed to separate that. They said, they're all pretty good drivers. Somehow my son got lumped in with my wife in driving safety and ability. So
or
really
because you lumped together your son and all of his friends who are all dangerous, then somehow that was supposed to make it really safe. Not sure how that works.
Okay, now let's do a definition. So this would be a good quiz question. So Vega is an estimate of how much the option premium will likely change with a 1% move in volatility. We go from, again, in our example, we go from 15% volatility up to 16% volatility. The option price will go up 23 cents. If it goes from 15 down to 14, the price would go down 23 cents. And so if you had a $10 stock, and it went up, you'd have
$10 option.
Or excuse me, a $10 option. You'd have a $10.23 profit. If it went down, you'd have a $9.77 money left. You'd have a 23 cent drop. Okay, and so let's go into our pattern that we followed with option chain, and we did delta, and we isolated it, and then we did Vega, and we isolated it. Now we're going to isolate theta, we did delta and we isolated it. We did theta and we isolated it. Now we're going to do Vega, And so this isn't so scary for us if we just isolate. Okay. So right here we have stock ABC, and it's trading, man. It's trading at 257. So this is a nice stock. It looks like they must be pretty solid if people are paying that much money for it right now. And we have a stock price of 257 simoleons. Okay. Now we have a call option price, or an option premium on the call side, a call option premium of $9.27. That's the mark. $9.27. And we got a Vega of 23. Okay. Now that's where it stands right now. Okay. Let's say that we had a 1% decrease in the implied volatility. That doesn't stand for intrinsic value anymore. That stands for implied volatility, okay? In implied volatility, okay? Well, what that means is the stock price, even if the stock price didn't move, okay? Even if the stock price didn't move. So let's say the stock price stays fast. The stock price is at 257 still, okay? But just because of this change in volatility, all by its little self, the option price, the option premium, the price of the option, would actually have a decrease of 23 cents. So you'd be down to $9. And I believe that's 4 cents, isn't it?
Yep. Perfect.
So you'd have 904 right here. However, if we're to see an additional 1%, an increase by 1% in implied volatility, then let's say our stock price, was the same. Let's say it didn't move. In theory, let's say the stock price in theory didn't even move, 257. And let's say that the option price will move by how much? Well, let's write this down. Option premium.
So we bought it for $9.27.
We've got to add
1% increase in implied volatility. So we're going to add the Vega of 23 cents, and that's going to put us at 960 if I'm
960
doing
even.
It right.
Yep, it is 960 even. Or is that 950?
Oh, whoops,
I don't know,
950.
30.
Yep.
It's
that's why I shouldn't do it in my head. 950. Sorry.
Okay, so it's $9.50 there. So you can see we're kind of getting used to this game now of doing this again. And the reason this is such an important thing is, in the first one we had the price move, but in Delta, but in Theta we didn't have the price move, and yet the option price moved. And now again we see here in Vega that the stock price didn't move, but the option price moved. So when the stock changes, the option price will move. But the stock price might change, might stay the same, and the option price can still move. And it can still move with decreases in time, which will happen for sure. And it can also happen with increases or decreases in volatility. So all three of these balls we're juggling in the air when we trade options. And it might seem a little bit daunting at first, but it actually, it's kind of like driving a car. When you do that stick shift at first, you're really just concentrated on the stick shift. And, when you're first learning how to use that freaking cell phone, and you're like me and you got these big fingers and you're not tech savvy, you're struggling focusing on the cell phone. And, the other thing, I'm not really good when I have my secret life and I put my lipstick on and my stilettos. Doing lipstick for me is a tough deal, let me tell you. I mean, it's hard. Doing that eyeshadow thing, it took me a while to get that down. So with the makeup, I was struggling. With the texting, I was struggling. And with the stick shift, I was struggling. And in my life, I struggle with all three of those tasks. But see, now when I go out on the town, even though I shouldn't, I can text while I drive while putting on my eyeshadow at the same time. I can do all three, and it's not a problem.
Bosom buddies type of thing?
It's kind of that, little thing, I don't know. Marcy doesn't know. So remember, what happens in Ultimate Options just stays right here. Okay?
It stays right here.
So yeah, I mean, hey, it takes a little while to get those balls in the air. It took a while to learn how to text and send email. Right now you can do it easy. It took a while to learn how to drive. Now you can do it easy. It took a while to learn how to do a foul shot. Now I can do it easy. And, actually juggling's really easy for me right now. You throw me 3 baseballs, I can juggle, and, that's fun. And, it's no big deal. I can juggle indefinitely, until I get really, 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 really tired. So you can learn to juggle 3 balls, and you can learn to look at delta and Vega and theta, all 3 at the same time. So let's look at some of the behaviors of this and just notice that as you get further away from an at the money, so here's our 257, so that's pretty close to 260. So here is our at the money option. These options right here on the call side are really in the money, and these calls out here are out of the money options. On the put side, same difference. Here we are at the money, and these are really close. Here are at the monies, very close. At the money. I guess which one's closest? I guess 255 is really the closest, if we want to look at it that way. And then in here, it's just the opposite, like we said. These are, very much in the money, and these here are very much out of the money that way. But notice that the Vega is here, its largest at the money. Why is that, Corey?
Yeah, so always remember those at the money options. There's a reason they have the most time decay. There's a reason they have the most potential for volatility changes for Vega. And so, and the delta is always around 50. And that's those at the monies have the most what we call extrinsic value or time value priced into them. And that's the reason why. So if you just did some simple math here, if we take the deepest in the money call of the 245, we'd say, well, with the stock at 257, it's $12 in the money. See the difference, 245 to 257. So we have $12 of intrinsic. Since it's trading at 15.52, we have $3.52 of time value, right? Of time and potential in it. Well, 352 is not that much when compared to the at the money. Look at the 260, which is slightly out of the money, and it has 687 of time and volatility priced into it. So its time value is much higher. And if we go way out of the money, notice that the 275s, they're pure time value, and it's only 243. It's all time value, but it's a smaller amount. So those at the monies have the most time value in them. And because of that, that's the factor that changes a lot due to time decay. So theta is always highest there.
Yep. Due
to volatility changes. It's those that have that big lump sum amount of time value. So they really have these factors moving more in terms of their value changes. So if you're thinking of it from the option standpoint, if you trade an in-the-money option, you're going to have less theta potential movement and less Vega potential movement. If you trade out of the money, you're going to have less theta and less Vega. It's still going to happen, but it's going to be less. If you trade the at the monies, that's where the Vega numbers are higher. That's where the theta numbers are higher. So traders do like to use those at the monies because they like to take advantage of that. But just know that it's kind of a bigger risk, bigger reward type of situation with those at the money options that way.
For sure. Now, here's an interesting idea too, is, this is still ABC stock trading at 257. But, Corey talked about time, and how that affect things. This one is 21 days to expiration. This is 200 days to expiration. Same stock, but different options, right? One of them only has 21 days left. One of them has, months and months and months, 200 days left. Notice that the 260 strike, we'll just go with the 260, here the Vega's 24, here the Vega's 78. So the further out now we still have we still have it going down from 24, 23, 20, and 15 24, 23, 21, and 18. We still have this going down. 78, 75, 74, and 72. 78, 77, 77, 76. So those trends...
It's still largest at the money strike.
Still largest here at the money strikes, However, there's a lot more sensitivity to volatility when you're talking about what could happen 200 days in the future. There's a lot more sensitivity that way because, it's a little easier for me to guess what's going to happen in my son's life this week. I'll tell you what, I'm pretty confident. I'm not 100% confident. But you know what? Zach's a rule follower. He's a pretty good kid. And he's a pre-teenager. And I don't think I'm going to get a police call saying, hey, your kid was selling drugs at school this week. I think the chances of that happening, he's not that volatile of a kid. Okay, but if you say, am I going to get that call in the next 10 years? Much more likely. Things change. It's harder to see. And so the further out you go, the more possibilities, the more risk there simply is of the unknown. Look, if I'm going to play one basketball game, my chances of breaking my arm are smaller than if I play 30 basketball games. And if I'm an NBA player, in my dreams, I'm going to play 82 games a year, and that's if I don't even make the playoffs. So is that fair to say, Corey, that the longer out you go, more stuff can happen?
Yeah, exactly right. More potential for change in that option price due to Vega. So the longer term options, and this is where it differs. Remember, on Theta, it was the other way around. Yeah. Theta's higher for the shorter term options and then smaller for the longer term. You get less time decay.
Yeah.
But Vega, it's not that way. It's flipped around where there's higher Vega numbers on the longer term option.
Right, for sure. So that's a big deal. Okay. So where do you go to look at this stuff, right? Where do we get this information? Well, there's two places we care about volatility. First, we look at our option chain. We can find it, in the option chain. But the other place we can find it is on an implied volatility graph. And that's what this looks like. So this is tracking the changes in volatility. So right here, I have a 0.36, and up here, in this area, I have it up here at 0.60 up here, and down here I'm at 0.3. So tell me,
Andy, I lost your sound. Whoops.
Oh, whoop! Really?
Oh, I think you're probably okay. It skipped out for me just a second.
Okay. All right. Well, I don't want to be. I don't want to. Okay.
Yeah, exactly.
So here I was at 60, and down here I'm at 36. It looks like 36. So tell me what the difference between 60 and 36 is. Tell me what happened on this volatility graph.
Yeah. So basically, expectations for risk decreased, right? You have the implied volatility dropping over that time period, and that can happen for a number of different reasons. Some of the common reasons for that are the stock price movement kind of justified that. If a stock is showing a history of just moving less and less, has lower beta, as we call it, lower volatility, then it's going to get priced into the options, and that implied volatility is going to drop accordingly.
So what percent drop did we see here from 0.60 to 0.36? What percent drop did you see in something like that?
Yeah, so that'd be 24.
Yeah, so that's in the stock. Okay, the option will be a little bit different, but drop in the stock's volatility will affect the option's volatility too. So this is actually not going to be what we look at in the option or in the stock, but this is one for stock. This won't be what we look at in the option, but this is to see the volatility of the stock. Is that right, Corey?
That's right. That's exactly right.
Now watch this. To the naked eye, this looks like just a regular old graph, and if my mouse crashes, it certainly has that appearance. Bam. We're back in theater mode. Wait a minute, I got to turn my drawing tool back on. Okay, let's get back in theater mode here. Okay, to the naked eye, this looks like, an unassuming stock. But to the trained eye like Corey Halliday, we might see something here. Look at that sharp. That's different than the other ones. And you know
Yep.
what? That's different than the other ones. And you know what? That one looks pretty different than the other ones. Isn't that interesting? And what's interesting is that's coming every
About every
what?
3 months.
Every
Every
three
3 months,
months. So
right?
every 3 months, this thing freaks out. Every 3 months, this thing freaks out. Okay. I'm like that. I'm like that. Once a year in March, I get a little crazy. Once a year in March, March Madness comes, I get a little crazy, right? Or whatever. Some people do this at Christmas time, right? So this is very cyclical. Well, what happens every 3 months?
Yeah, that's earnings reports, right? They give
Earnings
a
reports.
state of the company address, essentially. They update all their numbers and say, here's what we did well, here's what we did poorly. And it's a place where, basically the market starts to reprice stocks, says, okay, here's our expectation for how this stock's going to move in the future and how much they're going to earn and how much we're willing to pay for it and so forth. So it's a big deal for companies and for stocks. And because of that, the stock price will have certain tendencies as far as movement, and also volatility will have certain tendencies around earnings.
So let's just take a look at this right here. And let's go back a little bit. And let's have some fun. So let's say this is the price of the stock. And I've just built some candles, and interesting. They're all Maribozu candles. We have no
Yeah.
dojis. We have no,
No wicks at all. Yeah.
we have no shooting stars and hammers. We have Marubozu candles. We have no bullish engulfings. No haramis. But
Yeah.
it's just to get the point, which is really important. Um, and we have earnings reports right here, like this. And if you've been in the Mentor Club, this will be helpful to you because you'll say, this is starting to make a lot more sense right here. Is, down these earnings reports right here, they correlate. You'll also notice that we had a gap here, 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 we had a gap here. So it was true. On this earnings report, there was probably bad news or bad guidance because the stock gapped down. On this earnings report, same thing, bad earnings, bad guidance, maybe gapped down. On this earnings report, they must have done really well because it gapped up, and on this earnings report, gapped down, this one gapped up. So it really does speak to the idea that, volatility and the chances of this thing moving a lot gets higher going into an earnings date. And this is very typical to see this get higher going, and it's not perfect, okay? You can have downward stuff like this, all the time. But as a general rule, it looks to me like the trend gets higher going into an earnings situation. Generally, the trend is higher going into the earnings. But you can see the trend is downward just immediately right after the earnings. Now, this isn't guaranteed, okay? This isn't guaranteed. But I'll tell you what, Corey, it's pretty darn consistent for the most part, right?
Yeah, it's pretty good on the predictability side where this is the tendency, and it makes sense. Remember, down on the bottom, we're talking about implied volatility or market's expectations for movement, and you can think of it as fear. How fearful is the market? And when you think about kind of this earnings report, I like to think of it in three ways. The stock tends to move more than it does on a normal day. However, that's priced in many ways, right? Because the option has a tendency to rise going into the earnings report because people are nervous or excited or whatever. And then as they give out the information, everybody kind of says, okay, it's as we expected most of the time. Most of the time, there's not some major change. It might be slightly better, slightly worse. But for the most part, it comes in and people kind of say it's not that big a deal, back to normal. And so that's why that volatility gets crushed. We call it a volatility crush because it has a tendency to drop after that unknown becomes known.
So that's called a volatility crush. We'll write that in, and these are what volatility crushes look like. Okay, it just gets crushed. Now this is very exciting to someone as opportunistic and crush as you and I are. Okay, you, me, Corey, we're excited because now we found another way to possibly seek opportunity in that we don't always have to predict stock price very much. And we're going to get us some trades called a short strangle, where we can possibly exploit volatility crushes to our favor and make money off them. Okay, well, that'll be for later. But right now we're going to build the foundation, and this is the story of the Maury here. Okay, here's the moral of your story: is we have three things now. Okay, we're getting along in our class here. We've got three things now that can affect this stock price. Three of them. Okay,
and can we call these the big three?
The big
Aren't
three.
They the big three.
I
right?
like it. It's kind of like LeBron James, Dwayne Wade, and Chris Bosh way back
when they were together.
When they were together in the Miami Heat,
Yeah.
way back. Yeah, it's really the big thing, the big three. Now we're going to talk about Gamma and Rho, and that's great and all, but these are the ones. So when you look at, so what is the crystal ball ability? You know, when we predict a stock price, well, right here in predicting stock price, how do we do that? Well, we do that with fundamental analysis, which is the first pillar. We do that with technical analysis, which is the second pillar. And we do the best we can to get every advantage. And if there is some level of accuracy with that, that's a fabulous thing. That's a fabulous thing. But these are really, what would you call these? These are speculative trades that are really based on appreciation or an increase of price. And I would say that this is we certainly find value. I would rather trade with fundamentals and technicals without them. But I'm wrong a lot more using these, which is why we have a fourth pillar, risk management. But I'd say, it's probably the least predictable. I mean, I'm just wrong a lot more on prices than I am on this. Would you agree?
Agreed completely.
Now,
it's really the hardest element to predict. So
I will, and I'll put this in two. I'll say I'm pretty crappy. Well, I wouldn't say I'm crappy because these do help. So you have the direction. Is it going north or south? If you want to bump this up to here, this is the least in direction. If you wanted to bump one up to here, I'm actually not bad at guessing a range. I'm not too bad at that.
Yeah.
So what I'm saying is stock's $100 and you say, is it going up or going down? That's the direction. Well, this stuff will get you so far. But if you say, I think it will stay under 1,000 and I think it'll be above 0, you're probably going to increase quite a bit in your accuracy. So what you're going to find is we're going to find option strategies when it comes here. You'll find that Corey and I actually lean towards option strategies where when it comes to price, choosing the direction, our fundamental analysis and our technical analysis will be pretty good. I bet Corey can beat most people in direction stuff, right? How far it will go, who knows. But if we go with a range, we can bump this up to much, 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 much higher. Not a guarantee, not up where time is, but a little bit higher. Would that be safe to say?
Agreed. And that's really the best way to trade price. It's very, very difficult. Well, it's impossible to say, I'm going to trade this option on this stock because it's going to go from $100 to $110 per share, and it's going to finish at 110 on such and such a date, or it's much easier to say, you know what, it's going up, and it's going to finish between this 105 to 115 price range, and so I can structure a strategy that will take advantage of that. That's more realistic than to think that you can predict every change in price and where it's going to finish on such and such a day and so forth. Is just it's impossible, basically. So you can get ranges right, but that's where it's areas, it's price zones that we're looking for. So great example.
Now time. Time. This is my favorite one. I mean, we got hearts and flowers and, clover. Time is my favorite one because I see it, look, it's going to expire. And that's why insurance companies love time. Look, it's going to expire. And I know the date when it's going to expire. Boy, we had a hard time guessing that price out. Say, Andy, when it's going to expire? Third Friday of April. It's when it expires. Third Friday of April. Done. Got it. Know what it's going to do. It's going to be zero. Think about that. Man, if you knew that the price of gold was going to zero and you knew the day that it was going to go to zero on, would you short gold, Corey?
Oh, yeah. No question.
If you knew that the price of Apple was going to go to zero by the third Friday of the month, would you short Apple, Corey?
Absolutely.
Boy, I'll tell you what, that'd be a no-brainer if you knew that. Well, the nice thing is about time is at least we have a component that's predictable. We at least know the date on which the time portion, we don't know the intrinsic value portion, but we do know for sure what direction that time will go. And it's going to go down on expiration. It's going to be gone.
Yeah, we know it will hit zero. The time element of the option premium will end up worthless, zero at expiration. There could be some intrinsic value. We could still end up, losing if there was too much movement, price movement or intrinsic value against us, and we can hedge that and so forth. But we know where the time decay is going to take the time value of that option, and that's to zero on the expiration date. So for good reason, we love that.
This one right here isn't quite as good as time, but it's a lot easier than price. And, there's those blindsided ones that we struggle with, the unknowns. But you talked about known events and unknown events, known unknowns and unknown unknowns. Well, a known unknown, if we can use that, what is that, a oxymoron?
Yeah.
Look, I don't know, like P&G. I don't know what the earnings are going to be on P&G, but I do know that we will know on, September 27th
such
or whatever,
date.
right? Yeah, whatever it is. And so I can say, look, I don't know what's going to happen, but I know something could. So it's kind of like saying, look, I think we're going to have a natural disaster like an earthquake on Friday. I don't know the magnitude of it, but I do know it's going to happen. I know something could, and maybe there's a little tremor and nothing really happens, or maybe it's a, Richter scale, 7 and everything's devastated, but at least know the date of the earthquake. And because I know the date of the earthquake, I just don't know its magnitude, that helps me. That's pretty cool. Now, sometimes the earthquake comes and I didn't see it coming, and that's why this one isn't perfect. But here's what's cool is you're saying, well, God, how do I juggle these three balls? How do this? Watch this. We're going to learn, and we'll get into this, but we're going to learn how to categorize these. So the first thing we'll do with a trade is every trade we teach you, and you should have never traded without this knowledge on a serious way. I don't care if you open up your account after 4 pillars and trade a little bit, and after Mentor Club trade a little bit. That's your choice. It's always your choice. But once you have a solid foundation of these Greeks, we can say, look, a trade might be delta positive, might be delta negative, or it might be delta neutral, right? And then we say, okay, is this theta positive or theta negative, right? Does theta help, or does it help me, or does it hurt me? And then we'll say on this, is this Vega positive or Vega positive or Vega negative, is it going to help me? And what's really cool is our exit strategies and our hedges can pour antacid on this to neutralize it. In other words, we can set up and buy certain options that say, look, this thing's going nuts. We're having a hard time. I want to neutralize this, so if the price goes up and the price goes down, it ain't going to affect me. It's not going to hurt me. We can do that. So again, let's beat that dead horse one more time. Are you glad we're learning about this stuff before we delve into strategies? It's important stuff. So we'll get into that, but just know we're going to be right by your side. We're going to help you learn how to juggle these. And you're going to get the point, if you keep, waxing on and waxing off, you get to the point where you can think about these very, very quickly and very, very easily. So I might say, okay, Corey, you're long a single call option. He says, well, that's going to be delta positive because if the price goes up, that's going to help me. It's going to be theta negative because as time goes on, it hurts me. And it's going to be Vega positive because if the implied volatility goes up, it's going to help me. And you'll be able to do that with every trade, right, Corey?
That's exactly right. That's a great way of putting it, where each of these three elements, you can figure out if your strategy is taking advantage of them or, and sometimes negative is not a bad thing. Maybe
Right.
we want to be in a situation where we're actually going to have time decay hurting us. Because sometimes we want to be long the option. We want to profit in a growth strategy because we think this asset is going up in value. We want to buy those calls. So It's okay that time decay is hurting us. We're just going to minimize the effects. And you're already answering the question. You're already saying, oh, I know how to do that. I'm going to go out there and I'm going to buy the 5-month, the 4-month option so that the time decay is less. So sometimes just because one element is a negative, we might be okay with that. We know how to minimize that scenario so it's not the worst case and we can manage it.
Another thing that's going to be important is as you have stock XYZ and as you have stock ABC and as you have stock Acme Incorporated and as you have stock photography in Strange Lens by CoreyHalliday.com.org and as you have the Andy Tanner world of really poor humor where when you tell a joke you can hear a mouse pee on a cotton ball.com. Okay, when you have all these, you'll have a delta, you'll have a theta, and you'll have a vega, and there'll be numbers in all these categories. But then you'll have a total, right? And you'll see what your total delta is, and that's your exposure to price movement. And you'll see what your total time decay is, and that'll tell you what your cash flow is on time, whether it's positive or negative. And you'll see what your total exposure to Vega is, so you know if there's an earthquake, whether it's going to help you or hurt you. And this is going to give you a better sense of how this can not just affect individual trades on individual stocks, but you can actually start to look at these numbers and make single trades that can help adjust or offset these to where you want to be. I very much like having a total theta that's very, very high, and then I'll manage my delta with risk and delta hedging. But I love having that time tick away no matter what. I love having a high theta no matter what my delta and my vega are. I like having high time decay. What do you think, Corey?
Yeah, it's the most predictable, and it's that cash flow example where, if nothing happens, you're profiting from time decay, and that's a very good spot to be in most of the time. And then if there is a price move that's starting to occur that could hurt you on the delta side, there are ways to hedge that and to minimize the damage that way. So you continually have kind of that time decay working for you. I'm a big fan of that personally.
So now when you buy a call option, let's say, and hopefully you know what a call is. If you don't, you got to go back and review. But now if you buy a call option, you won't just be thinking about price. You'll be thinking, okay, how far does it have to go before the time runs out on me? And you'll also be thinking if I'm buying an option, would you really want to buy a call option right here? Well, a couple of things. Number one, you got an earnings date you don't know about, but after usually the implied volatility goes down. Would it be better to buy the call option maybe right here? Well, technically, I have a double bottom, which is really nice. I might say, hey, this thing might fill its gap, which might be really nice, technically. I got a Maribozu candle breaking out right here, and my volatility is low. So not only would I get the stock increase, but I'd also get the volatility increase. That gives me a frickin' double whammy. So if the time is working against me, right? If the time is working against me until expiration, wouldn't I want to have both the price and the volatility working for me?
Yeah, what a great example right there. And tell me if you've heard this one before, Andy. A lot of traders will try to buy options right into an earnings report. So the day before or whatnot, and they'll say, you know what, I bought puts or I bought calls on this, and the stock went in my favor, went the direction I expected a little bit, yet my option has lost value. And they're very, confused by that because they didn't realize that there was a volatility component. They didn't realize that options have a tendency to get expensive into earnings. And if you think about the pricing mechanism, option sellers require a lot more premium to be willing to sell options into an earnings announcement.
Yeah, they bought them expensive.
They bought high, and then the volatility gets crushed. Their option loses value, and they can't kind of figure out what the stock moved a little bit in my favor.
The stock went up. It's because you paid so much for your darn insurance when you bought it.
Exactly right. And so it's, you got Delta moving a little bit in your favor, but Vega just killed you in that scenario. And so, in terms of strategy, what a great example with you where you were buying when the volatility was low and expected to ramp into earnings. So we had not only the nice, Delta opportunity, we were buying at the right time, but also the Vega opportunity where we were likely to see an increase in volatility going into earnings. And my guess is, you may have sold off that option before or done some other adjustment or something to profit from some volatility decay as you went into the earnings report. That would be a common structure or strategy. So cool stuff.
Again, Corey and I feel very close to our students because there's a real good chance we meet someday. Maybe we have a stock summit, up at Snowbird or Park City, and, we invite our very special students, something like that. It's not something we would put on a website or something. And, we wouldn't do something like that as a moneymaker of the company. We do it, for the mission, right? And so we might say, hey, for X amount, someone comes into a stock summit or Park City summit or something, secret, and X amount to come. At that point, it's really because we get to meet you and see you and hug. Corey's kind of a hugger. I'm not much of a hugger. I'm on stage with Than Merrill once. I like to hug. I shouldn't say that, but there's 4,000 people in the audience, and Than goes, Andy just loves hugs. Well, I don't mind hugs, but when you got 4,000 in a row, but I loved them. I took them all in. But it's just fun to touch people. And, I was in Canada and, we had a fun little stock summit up there and just to see the students, and the change. So we want to take good care of you because that's where we want to get you, someday to where you're really good at this. And I hope you can appreciate the sternness, kind of that parental coaching nature where I say, look, take your time in digesting this because now look at where we've come so far. Do your education continuum checkup here and say, okay, am I thinking better about how this could be than I was before? Am I understanding this stuff better than I was before? Even if it's a 1% refining, and we've got, 1,000 classes to go in this series so far. You've done 3 solid on Greeks, and we have so much more to go, but digest this. So I hope you can have an appreciation, and we thank you for your patience as we teach you to be a good student and to just buckle down and say, I'm going to paper trade this for a week, and I'm just going to take it a week at a time. Standard deviations. It's an interesting idea, isn't it? My son is pretty tall. I'm 6'8", so I'm pretty big. How big are you, Corey?
I've got a foot less than you, so I'm 5'8" tall.
5 foot 7.5 inches tall.
Yeah, exactly.
I'm kidding you. We're going to give
I'm
you the
gonna
full
round
8,
up
dude.
to 5'8".
No, we're going to give you the full 8. And we've played hoop together, right? So, so let's say the average person in the United States is, what? Average male, our age, maybe 5,
Yeah, 5'8", 5'9", something like that.
Yeah.
Probably
So
is
we'll call it
maybe
5'8",
5'8" is
5'9".
yeah.
So Corey is, average. Average, okay? You get up to where I am, this is where like abnormal Neanderthal Andy hangs out, okay? You pull 1,000 people, go to the mall, find 1,000 dudes, and the chances are I'm going to be one of the tallest guys. So I'm what you call an outlier, right? I'm way outside of the scale. And other people, if a guy is, 5'1" and he's a figure skater or a jockey, he's way over here. So the question is as you look at the whole population of children, they're 12 years old, one of the things that my son's pediatrician was really interested in is when I walk in at 6'8", Marcy's pretty tall, first thing she wanted to do is measure my son, this pediatrician, to say, is he one standard deviation? Whether it's how far does he deviate from the mean, the average, right?
Yep.
If the average 12-year-old is 5 foot, right? If the average 12-year-old was 5 foot, and she measures Zach and he's 5'8" at 12 years old, how far is he deviating? How far is he deviating, or what percentile is he in? And what we find is that if you took if there's a 68% chance that you're within one standard deviation of the mean, whether that's 1 inch or 2 inch or 3 inch, who knows what it is, but whatever that first standard deviation is, they said, look, 68% of the population, the vast majority are going to be, within 34% one way or the other of that mean, okay, of that mean. So, based on the amount of height that we can record, we can say, look, the human race with one standard deviation is X. It's this many inches, okay? But what's interesting is if you take this area right here in the blue, this is what's weird. There's a 95% chance that you're within 2 standard deviations. So, if you get out 2 standard deviations, you're really an outlier at that point. You're very much an outlier, right? Because, to get 2 standard deviations here, 95% of the kids are going to be within 2 standard deviations of that mean. But if you get out to this red line out here, okay, you get 3 standard deviations out here. It's like 99 point something percent chance that you're going to be within 3 standard deviations. So there's a 99% chance you'll be within 3. There's a 95% chance you'll be within 2. Or excuse me, I should have said it backwards. So to make sure you understand that, there is a 99% chance. Like, can I write 99 the right way? So to say that another way, there's a 99% chance you're going to be within these bars. There's a 95% chance you're going to be within those bars. There's a 68% chance you're going to be within these bars, right? 99% chance you're within 3 standard deviations of a guy in average height or a girl in average height. 95% chance you'll be within 2 standard deviations, and a 68% chance you'll be within 1 standard deviation.
Yeah, and you could say that in terms of, let's use an example. If the average height was 5 feet 8 inches tall,
yeah,
then and 1 standard deviation, let's call it 3 inches.
Right.
So 1 standard deviation below would be 5'5", and 1 standard deviation above would be 5'11", right? And so if you look at it, 68, let's say we had 100 males in the U.S., 68 of them are going to be in that height range. Yep. That's the vast majority, about 2/3, right? 95 out of the 100 are going to be within 2 standard deviations. So we take 3 inches further. So we go 5'2" on the shorter side, and we go 6'2" on the taller side, right?
So 90.
So now you're within
5% of people
are going to be in that
height range.
Are
going to fit within that height range, right? 95%.
And then you go Yeah, and then you go one more standard deviation, so go another 3 inches. Now you're between 6'5" and 4 feet 11 inches tall, and 99% are going to be inside of that height range. Now, what's kind of interesting about statistics is it's not always a perfect dispersion. You could have a fat tail, is what they call it.
Right.
So it could be that more are likely to be above 6'5" than below 4'11",
Right.
let's say. It
Right.
could be skewed just slightly. And
Right.
so you'd have a little bit higher probability on the one side than the other. They just call that a fat tail, where it's a little more likely we move this way than that way.
So we could do it the opposite. Okay. We could say, look, if you're going to have a baby, there is a 68% chance that he's going to be within this standard deviation height of, what we say, 5'5"
5'5" and 5'11".
and 5'11". Okay. And of course, you might be tall in genetics and all this stuff, but just randomly, if you go into a hospital at random and you pick up a kid at random, 68% chance he'll be within here. Okay. Now, to get out here, there's only going to be what is that? 32?
Yeah, so
There's only a 32% chance he'd get out here. And actually, since it's on both sides, it really would be less than
it would
that.
actually be, I think it shows 13.6, right?
Yeah.
So 13.6
That's
on
right.
one side and 13.6 on the other. So it ends up being about 27.2
Whatever it is.
together.
Yeah.
Yeah.
Okay. And if you go out here, there's only like a 2.1% chance. Okay. So when we trade stocks and choose a range, if I can get 2 standard deviations out, okay, I've only got a 2% chance here, 2% chance here. I've got about a 94% chance of being right. If I could get out and guess in this range, I've got like a, 95% chance of being right, or 6 or whatever it is. But if I go in here, I got a 68% chance of being right. So when we look at trading a range instead of a direction, that's why. That's why. So we'll look at the standard deviation of a stock to see just how volatile it is and how far it goes out to places. Well, just as I can do this with children, I can say, okay, here's how it works with children. Well, here's how it works with ABC stock. Not all stocks, just ABC stock. And I can get a personalized standard deviation. How far does this thing go from its average, from its mean? How far does it stray usually? And it'll tell me very, very accurately, within reason, what those are. Now, there's always anomalies. There's 9/11. There's bad things that can happen. But wouldn't it be nice to kind of have that? So as we look at volatility, okay, that's how it's done, is with these standard deviations. And it kind of gives that's where they get this from, is how far does it go from its mean. Is that right?
Yeah, exactly. So they're just looking at the stock's personality, and then you can put that into just basically this mathematical formula. So to use a stock example, if you had a stock at 50, it could have a 1 standard deviation between 53 and 47, right? That would be a 68%, a 1 standard deviation.
That would be ABC
68%.
stock.
Yeah, 68% chance it's going to be between 53 and 47 at expiration. And then if you went 1 standard deviation further, it would say, well, there's a 95% chance that it'll be between 44 on the low end, right? 1 more standard deviation, and 56 on the top end. So now they say that, okay, there's about a 95% chance, or 2 standard deviations is that range. So if we put on a strategy, we could actually say all we need is for it to not end up in this range, or all we need is for it to move into this range, and we can put some statistics around that.
We could look at XYZ, and maybe it's also $50, but it might have a standard deviation of 51 and 49 in the first one. And there's a
Right.
68% chance that it would stay in that. And then 48 and 52 is your next standard deviation. So this one has a different personality than this one. Which one's more volatile, Corey? ABC or
Yeah.
XYZ?
ABC is more volatile.
So,
Certainly expectations are much higher for volatility in that name.
and
Yep.
so we have high volatility. Now, if the volatility changes 1% over here, that would give me how I want to know what that's going to do my stock if this volatility changes 1%. And so that's going to give me my Vega. Over here, I
Yep.
want the same thing. If this changes 1%, if this one starts to look more like this one, how does that change my Vega? So it's a fun discussion to have. Vega tells us how much money the premium will change with a 1% change in volatility. These would be great quiz questions, I think. Implied volatility is kind of what is expected, right? It's not for sure. Implied volatility is that if we went back and took a look at this chart right here, at historical volatility, kind of skipped over that, it would look less, it probably wouldn't be the same as this one. And they can really vary. For example, where this is consolidating right here, the historical volatility would drop as it consolidates, right? In this area where it's consolidate, the historical volatility might drop a lot more because it's just not moving much, right? But in a big gap down right here, the historical volatility might rise up and match what it is right here, right, Corey? In a big
That's right.
drop right here, it might go way up as this went way down, So
Yep. So that historical volatility is just simply measuring the volatility of the stock. So during periods of consolidation, like he was showing, of course, historical volatility would drop down, meaning it's just not moving much. There's not much volatility in the shares. When there's a big price jump, well, then that historical volatility goes up to higher percentages because it's all just measuring how much volatility are in the shares.
Yeah,
exactly right.
This is what has happened in the past right here. This is old news. This is future. So really this is future and this is past, right? Volatility tends to rise as earning date approaches. We saw that. Volatility tends to drop after earnings released. We called that a volatility crush. Volatility is largest at the money options. Volatility is larger with long-term options. When selling options, you want Vega to drop. When buying options, you want Vega to rise. Here's the problem with cramming for a test is you only have so much RAM and you can only digest so much food. And one of the things I used to do is I loved to cram because I was lazy and I'd rather play basketball and hang out with my girlfriend than study. So the night before an exam, my problem was I would be the type of guy that would try to learn, Vega, delta, and theta all in one night. And to remember, volatility is largest at the money. Okay, let me ask you right now, where's delta largest at? Where's theta largest at? And how does delta work as you go in the money? And how does delta work as you go out of the money? How does volatility work as you go in the money or out of the money? See, that stuff takes time to digest. So part of what I ask of my students is the patience to study these one at a time, really nail down delta. And you can tell right now whether you've cheated or not, because right now, you either can answer that stuff about delta and theta or you can't. And it'll really set the tone for the next set of patients because we're going to do one more on Greeks, kind of sum these up, and then we're going to talk a little bit about rho and a little bit about gamma. They're not in part of the big three. And then we're going to go into some tools, some mindset stuff, how you ought to approach risk. And, we're going to be really smart about this stuff. So this is going to be a solid foundation. And what's important here is to say, okay, how good of a foundation do I want to have? It's like building a house. If your foundation isn't cured yet, do you really want to build a subfloor? And the subfloor isn't really finished and really, tied down well. Do you want to really start putting in load-bearing walls and a roof? So right here's a very important part. They're the big three. Before you go another step, it's okay to review. There's no quiz. It's okay. And, these classes have been a bit longer. Some will be 40 minutes. Some will be longer like these. But here's the key. Take your time and make sure one bite is digested before you go on to a new meal. Anything you want to say about that, Corey? Give yourself some slack. Give yourself some patience. Don't go crazy.
Absolutely. And I would just congratulate you on getting to this point. Understand that as you're starting to digest this and understand what Vega and Theta and Delta, you now know more than probably 90+% of the people trying to trade options. And so, you've taken some huge steps, and there's more to do. So start to put it into practice. It's like exercise. The more you work it out, the stronger it becomes. And that's exactly how this works. The more you put it into practice, the more you're going to retain that information, and it's going to fall into place. And if you feel like, you know what, it's not all sinking in, as you start to practice it, it will sink in. And those things that maybe you feel like you're not grasping yet, they'll fall right into place. So great job.
When I turned 50, oh my gosh, I'm a half century old. My wife was less than 50.
Yeah.
And, you can Jenny Craig this if you think, why Jenny Craig or, whoever, Weight Watchers, whatever, whoever sells those shakes on TV, they always say lose weight fast, and they promise fast results. And, okay, maybe you lose 3 inches in 2 weeks, whatever. But when I turned 50 and my wife turned something else that was less than 50, she's always been in pretty good shape. She says, I want to do a competition. I want to see how far I can get. And I got to tell you, day to day, you wouldn't see a change. But, you take a picture at a month, then 2 months, then 3 months, you saw huge changes. And all of a sudden, she's like, look at this. And, she always was slender, but now she got abs. It's like, I don't have abs. I got a keg. But that comes from, but the reason she got that is because she didn't try to Jenny Craig it in 2 weeks. She says, look, here's my diet, here's my nutrition, here's my weights, and here's my cardio. And she had a coach. And the coach had her check in once a week, not once a day, right? The coach checked in once a week. And that's how you do this. Because now, she's got this, she's solid, man. She's solid. Same true as a trader. You want to be a high competition level awesome trader. You do it like a workout, and tree rings come once a year. Great job.
Awesome stuff.